Hi, I'm JP Albano. In this video, I'm going to talk about what we do and how we break down the process of buying a multi-million-dollar apartment complex. I'm not talking about a duplex or a quad. I'm not talking about a 20 unit. I'm talking about a 200 or 300 unit apartment complex that's worth anywhere from 10 to 20 to 30 to 40 to $50 million. And while that might seem like a huge number, the reality is it's the same amount of work and effort and process that it is to buy a smaller apartment complex, like a 10 unit. So the first thing we do is we need access to deals. So we do that by establishing a relationship with brokers in the area, especially in the markets that we're looking to invest in. And these investments and these relationships with these brokers, they take time. They don't happen overnight. They take a lot of effort to cultivate and grow trust. And ultimately, the point of building these relationships is to be able to get to a point where a broker can feel like they can trust you, and they feel like if they were to bring you a deal, you and your group and your team have the ability and the wherewithal to be able to close that deal, to bring it home. That's really critical. So we have to, number one, establish these relationships with brokers so we get access to deals. When they get us deals, they'll present the deals to us, they'll give us the financials, and then it's our job to analyze the deals and determine if it meets our criteria and requirements for making an investment. The process of underwriting a deal is complex, it takes a lot of time, energy, and effort. And at my company, we have a full-time analyst that spends his entire day analyzing and looking at deals. After analysis, our goal with doing so is to try to disqualify the deal as much as possible. So we run it through a list of 30 to 40 different aspects of how we can disqualify a deal. Maybe it's based on area income, the size of the property, the location of the property, if it has a assumable mortgage on it, if it's got crazy low occupancy, if it's super old. These are just some of the things that we look at when determining if a deal is good enough to move forward to a full and more comprehensive analysis. If it does make it past that point, we decide as a team if it's something that we want to move forward with making an offer on. In order to make an offer, we put together what's called a letter of intent, an LOI. And basically it outlines the basic terms on which we would present our offer. So for example, it has things like the purchase price, the price per door, how much time we need to do our due diligence in the project, how much time we need after the due diligence inspection period to close the loan. Most deals close in a period of 30 to 90 days. Depends on a variety of factors, but that's typically the window from getting a deal under contract to when it's actually closed. That also gives us time to shop for a commercial loan that will be used to finance the property. And then it also allows us time to be able to put a deal together to present to our investors, many of whom are in tech sales, to raise the equity that we need for our deals to be able to close the remaining part of what's called the capital stack. Capital stack just means, what does the money look like for closing the apartment complex? There's going to be debt, which is in the form of a loan. The remaining pieces are probably going to be equity from the investors or the sponsors that are bringing cash to the deal to close the deal. If our offer is accepted, then we move forward with contacting our attorney to draft up a purchase and sale agreement. And this again will take the terms from our letter of intent, the timeline, the closing timeline, how much money we're buying it for, and put it into an actual contract. Once we're under contract, our due diligence period actually starts. This is where we'll engage with the bank and start getting the process going for a commercial loan. We'll also engage in any third parties for survey, for appraisals, and also for any kind of environmental studies that need to be done to the property to make sure that there aren't any sort of toxic wastes or environmental hazards that would cause us a problem later on down the road when we go to take on a loan, or more importantly, when we go to sell the property. Also during this time is where we're verifying that the financial statements that we get from the seller are true and accurate. We'll review their bank statements. We'll do an audit on their rent rolls to make sure that the leases they have on file match to what's on the rent roll itself. It's relatively easy to doctor a rent roll and make it seem higher than what it actually is. So we have to verify that the leases that are in place are actually true and legitimate. And I mentioned this earlier, the next step is raising capital from our tech sales investor club. We present an investment opportunity to people that are in our community as a chance to grow their wealth, pay less on taxes than they're typically paying on their W-2 sales income, and earn passive income that's diversified from their sales income. Next step would be closing on the property. That again happens 30 to 90 days after we get under contract. And then the real fun begins for our group, because unlike other sponsors who maybe rely on third-party property managers, we manage our properties all in-house. So the real work begins when we roll up our sleeves and close, because that's when we're taking over the property, collecting the keys, and notifying the residents there that there's a new sheriff in town, and we begin our renovation process. And there you have it. Those are essentially the steps that are needed to acquire a commercial real estate apartment complex. If you enjoyed this and learned something, go ahead and subscribe to my channel for more.